Today, we will talk about growth companies. A growth company is any company that generates positive cash flows or earnings at a much faster rate than the overall economy. These companies typically reinvest their earnings back into the company rather than paying out dividends to shareholders. An example of a growth company is Google, which has seen substantial revenue, cash flow, and earnings growth since its IPO. Growth companies are known for their sustained higher-than-average earnings, free cash flow, and spending on research and development. Unlike mature companies, growth companies are expected to increase profits significantly in the future, which is why the market gives them high valuations. These companies pay lower dividends than value stocks because they reinvest their profits to drive earnings growth instead of focusing on dividend growth. In bull markets, growth stocks tend to outperform value stocks due to the lower perceived risk. However, during bear markets, growth stocks tend to underperform value stocks because of weak economic activity hindering sales growth. Mature companies tend to weather bear markets better due to their established nature and stronger financials, making it easier for them to raise capital. The majority of growth companies are found in the technology sector, where rapid innovation and growth spending are typical. Companies like Google, Tesla, and Amazon are considered classic examples of growth companies due to their continued investment in innovative technologies, sales growth, and expansion into new businesses. Another example is Etsy, the e-commerce retail platform that sells a large array of vintage and craft items. Here are 6 key takeaways. 1. A growth company generates positive cash flows or earnings faster than the overall economy. 2. Growth companies typically reinvest their earnings back into the company to continue spurring growth. 3. Growth companies stand in contrast to mature companies, which tend to report stable earnings with little to no growth. 4. Mature companies typically have an easier time obtaining financing than growth companies due to their established business and financials. 5. Investors in growth companies are focused on the appreciation of the company's share price rather than on dividend income. 6. In today's economy, the technology sector is characterized as having many growth companies. Hope this would help. Thanks for watching.